Hello, and welcome to your August Investor Update. I'm James McManus, Chief Investment Officer at Nutmeg. In this update, I'll be looking at financial market performance in July, the start of the reporting of results from the second quarter, and the latest interest rate decisions from major central banks. How did global financial markets perform in July? July was a tale of two halves for global equity markets. Rising in the first half of the month, they largely gave back their gains in the final fortnight. And this meant a broadly flat end to the month for global equities in sterling terms. However, a stronger pound has worked against UK investors in foreign stock markets, reducing the value of investments in foreign currency. The greatest losses were felt by larger companies in two regions which until July had been this year's top performing, the US and Japan. Smaller companies, though, had a relatively strong month, buoyed by the potential for lower interest rates in the coming weeks. In the US, smaller companies rose by 7.7% in July alone. And closer to home, UK equities have performed strongly in July, with large caps rising 2.5% and mid caps up 6.7%. In emerging markets, standout performances from India, Brazil and Mexico were muted by lagging major Asian economies. Bond markets delivered positive returns in July, with government bonds in the US and UK rising 3 and 2% respectively. Within corporate bond markets, the top performers were high yield bonds, with returns of 2%. Those returns are compensating for higher risks, as those companies have lower credit ratings. Now, since the end of July, financial markets have been volatile as investors digested the latest central bank decisions and company earnings alongside weaker than expected data for employment in the United States. And this has resulted in losses in global equity markets as investors readjust portfolios. Yet we continue to believe the outlook for economic growth is rosier than the current market environment would suggest. Volatility is a part of investing in financial markets, but it can still be uncomfortable to see the value of your portfolio fluctuate. However, as is the case whenever markets are volatile short term, remaining focused on your long-term goals is the key to investment success. Companies across the globe have begun reporting their results for the second quarter of 2024. What have we learnt so far? Put simply, I think what we've learnt is that expectations are high. While earnings have been largely robust, not all investors have been satisfied. And this disappointment is reflected in some falls in share prices. Microsoft is a good example of this. Investors appeared disillusioned with the slowing growth of Microsoft's cloud computing business reported in late July. But with growth of 29% in the last quarter and a rise in the contribution from artificial intelligence, that perspective needs to be treated with some caution. Now, around half of all US large companies had reported second quarter earnings by July's close, and the results have been broadly positive. So far, earnings expectations have been beaten in most sectors, though the weakness in consumer discretionary sector is being watched closely. Elsewhere in developed markets, results have not been as strong as the US, but fewer companies have reported so far. In emerging markets, meanwhile, earnings have exceeded expectations by some margin, though only around 20% of companies have reported results. And as with all markets, we're going to need to wait until we see the full picture there before forming any conclusions. Central bank activity has been another focus for investors. How are markets reacting? Most Western central banks are debating when to cut interest rates, but Japan is still in the very early stages of raising rates. In July, their central bank raised interest rates to 0.25%, continuing a journey that began with the end of negative interest rates in Japan in March. And that was largely unexpected by investors, but it represents a cautious approach which will no doubt continue given the reaction we've seen in currency markets to that decision, one cause of the market volatility in August. In the US, the Federal Reserve once again held interest rates firm, but strongly signaled that September will be the month in which they make the first adjustment lower. Employment data released since the Fed's decision has led some investors to question whether they've been too cautious, and amid market volatility in early August, financial markets are now expecting close to 5 cuts to interest rates before the year end. And in the UK, the Bank of England reduced the base rate by 0.25%, the first decrease since COVID, and it was a tight decision amongst the voting members at 5 votes to 4. That cut will be welcome news to businesses and consumers who've been contending with interest rates at a 16-year high, but we believe that the Bank of England will need to take a cautious approach to further rate reduction, given the UK's elevated wages growth and updated economic growth forecasts. For more on what that means for investors, you can explore our in-depth commentary on the Insights section of the Nutmeg website. Thanks for watching. If you have any questions or suggestions for a topic you'd like us to discuss in next month's Investor Update, You can contact us via social media, email, or in the comments section below this video.